Good morning, traders. Today is May 22nd, Sunday. Very interesting week setting up again. Markets continue to roll lower, but I'm going to show you why we're getting very, very close to a bottom. First off, we're going to look at the TT scanner image for this week. TT scanner has got a couple of current trades. The RWX real estate fund went flat. The biotech fund went flat. Got a couple of long trades up here in XOP, IXC, one here in XLU, one here in XLE. Notice these are all energy sectors. And one here in healthcare that's been going on for quite a while and is still 15% profit, getting closer to the stop. It's only $1 or so away from the stop right now. So this could get stopped out this week. Number of new trades last week here are continuing to stay short, which we have IBB, FDN short. We have XLC, communications sector. We have technology expanded, IGM. We have IYC, consumer discretionary. We have IGV, QTech, and XT. All short, all just 2 or 3 weeks old. Some have hit their first targets already, but this shows you that the markets are pulling away from rallying mode, particularly technology right now. Okay, so let's come over here and take a look at the Fangs Index. What we're going to do here is look at our index charts to show you what's going on. The Fangs Index is broken out of this channel below these trends, setting up a double bottom, potential double bottom over here with extreme selling. This is deeper selling than we saw in the end of 2018 or in COVID. This is a very deep bottom setting up. I believe we're going to be very close to trying to find a bottom here. And possibly this coming week or next week, I think we're going to start to look to see a bottom. And I'll show you that on some of these other custom index charts that I'm going to show you. The U.S. stock market index has rolled lower. It's down below the 382% retracement. I want you to pay attention to this level here. Again, this range that I drew this weekend between the 618 and 382 level looks like it could be trying to find a bottom. We could see it still move a little bit lower here on a bit more of a washout, but I'm very, very cautious that we're seeing a washout low setup here. This deep, deep selling should set up some sort of an intermediate bottom here. Like I told you, I really do believe this is a wave 4 pullback, setting up a wave 5, and we could see a big move to the upside. The Smart Cash Index, which is more of a global market index, has come all the way back down into this support zone that I've drawn in red. You can see it here with the Fibonacci levels. This goes from the 2016 low all the way up to the 2018 peak. I believe that we're going to try to find some support here. You can see it actually rolled a bit higher last week. And I believe that traders are starting to really shift capital into potential opportunities, one of which I'll highlight today as we move forward with this. So I believe we're getting very, very close to some sort of a washout. Now, we could see some other type of an event take place to push this even deeper, but the support level that I've been telling you is setting up, looks like it's setting up fairly strongly. We saw a nice upward move here in the Smart Cash Index last week, which is quite unusual. The U.S. market's moving down, Smart Cash Index moving higher on a price basis. It shows us that there's some buying taking place in the market right now. The Metals Index, I'm calling this the yellow brick road, this trend channel here, and I'll tell you that this is a very solid low. You can see it's carried across all of these levels, and we've come back down to this level. We've seen some very strong support down in this area. This is very likely to be a very solid bottom for metals moving forward. I believe we're going to see metals climb back higher here now that this washout period is over. Next is the Valuations Index, continues to move lower. We're back down into these 2016-17 ranges. Remember, this was when the Fed was still pouring money into the market, still trying to support the economy, very moderate inflation. We started to get some real big inflation numbers back over here, right around this 2019 area, and then we hit COVID. Now we've washed all of that back out. Very likely that we're going to see this valuations index continue to move downward or consolidate, meaning we're not going to see any type rip your face off type of rally, any big blowout type of move. We still have to transition through this, but there is starting to get some opportunity back in the market. We're starting to move back down into normal levels for valuations here. We could still see many weeks of a consolidation and possibly even a deeper low eventually, but we're getting back down into more normal levels. We've wiped out all of the excesses from the 2019 COVID, post-COVID excesses. We're now down to levels that are considered moderately normal. I would suggest that moving down below, say, 61, 62, which is this middle level, would be a very strong sign that the markets are getting very, very close to a bottom. The commodity to gold index has done the same thing. It's moved back down into these extreme low levels. So in reality, what we're seeing here is commodities are decreasing. Now, granted, oil hasn't decreased yet, and others haven't decreased yet, but we're starting to see some very low levels here. You can see this 1.8 level, follow this red line right across, puts us down into these extreme lows, down near these extreme lows. The only thing that's really been lower down here is COVID, or back down here in 2016. So if we continue to see this meltdown, this is telling you that consumers are strongly pulling away from big ticket purchases and engagement in the excesses that we've seen before. And this will likely to continue to move lower as consumers react to the inflationary tendencies and trends. And then, of course, we have the volatility index, which is, as I've been telling you, warning that we have a nice little bottom setting up in the markets. Granted, prices have continued to stay under somewhat pressure downward, but understand that this sideways move right here over the past 5 or 6 weeks is really telling us that the U.S. markets, are actively seeking out a bottom. You can see here 2018, same type of activity happen. You can see here we saw this take place a little bit early. Then we had this washout low, which could still happen. We could get a washout low and then immediately back up. So understand that the markets right now are really trying to find support, U.S. markets, but we could see this still wash out down here in the, call it the 4.6, 4.8 range, maybe 5 point something, and then start to scream back higher. So understand that the markets are really trying to find some support. So now we will come to a quick look at the real estate conditions. This is updating every week now for you guys, and I've added some more data. We have median listing price year over year is this dark blue line. Active listing count is this dark orange line. The median days on market is the gray line. The price reduction count is the yellow line shooting way up here. And the price reduced share is the lighter green line or lighter blue line here. So now what you need to pay attention with this right now is the rising active listing count right here. Active listings are going almost straight up. We haven't seen this since back here in 2021. We haven't seen really active listings start to skyrocket like this in quite a while. You can see way back over here, we haven't seen this week over week active listing counts come up. Price reductions are going skyrocketing. They're almost 60% right now of all properties on the market are being reduced. Average price level year over year is still relatively high, but reductions here in pricing are going to start to weigh on pricing levels. And you can see the share being reduced. So this is the price reduced share year over year is going higher and higher. This light blue line will come up as well. Days on market, which is this gray line right over here, has really started to move higher, and I'm waiting for it to get up above this positive number. So right now, this negative number means that it's still, houses are still moving on a quantitative basis. But remember, this data can sometimes be 5, 6, 7, 8 weeks delayed. What's really important right now is to show you that, as of the last 2 months, if you take a look at this, there's been a big disruption in active listing right before the Fed. A lot of homes hit the market, and a lot of homes were sold off right before the Fed at high prices. prices continue to mediate or moderate higher. But look at this reduction count here, and look at this here. The active listing count is skyrocketing. That tells me that homeowners are trying to dump property at the highest price they can before buyers become aware of what the Fed's doing and what the market is doing. So people are trying to dump their real estate right now at the highest price that they can possibly get. And you're going to probably see this price reduction count, this level here, move up into the 80, 85 level here very quickly. People are going to really start to become aggressive to try to dump their houses as quickly as possible, especially as foreclosures and other pricing pressures start to ramp up. So remember, we're at the very early stages of this, but there's never been anything like this. I mean, look at this. This is going back to 2017. We've never seen price reductions up at 60%, okay? While home price averages are rising 16% year over year, and while active listings have now reached the highest level in the last, well, if my numbers are correct, going across this peak, these are the highest levels we've seen in the last 6 years. People are really dumping real estate right now. Okay, quick focus on this. This is a highlight of the phases of credit expansion and depreciationary cycle phases. So understand that these are my cycle analysis. These are depreciation cycle phases. The only time we didn't see gold actually start to really rally, this is gold. The chart, the candlesticks down here, is in the 1980, call it 88 to 96 range, which was the Reagan-Clinton years. I need you to understand this, is that this was the end of the gold standard back in the 70s, early 70s. We saw a big influx of credit, gold shot up. Then we ended up in a period of almost call it stagflation after 85, 86, 87, 88. And then we ended up in the Reagan-Clinton years where there was, almost a stagnation in gold. There was no real fear in the markets. Then after the dot-com bubble burst, we saw a bit of a bump in gold here and started a massive wave of credit expansion. This was the Federal Reserve essentially making easy money policy, and we saw this massive inflationary wave to see gold move from roughly $250, $300 an ounce all the way up to $2,000 an ounce. Now we've seen, after the 2008-9 credit crisis, through this phase, we've seen a pullback. We've seen another massive expansion in credit, in the monetary policy, creating new money, creating debt. And I believe we're going to see another massive rally in gold through this expansionary phase. We've still got between now and roughly 2027, 2028 to end this depreciation cycle phase. And in reality, we're very early on in this move for gold. Gold could be well up above $3,200, $3,300 an ounce long before this cycle phase ends. So be aware that we're seeing a very big expansion of credit globally. It's going to create a lot of fear through the unwinding process, and gold is just now starting to really bounce. If you were to look at where we're at right here in this gold cycle phase, I would say we're very close to possibly right in this area. Now, we've seen the expansion, we've seen the base, we've seen it come up, we've seen a little bit of consolidation here. Now we're getting ready for this next big phase, which is, again, possibly 100 to 200% or more from where we're at. And that'll put us up above $4,500 an ounce roughly for gold. Next, we will look at the Fed graph showing how debt has been created. This goes along with the other chart that we had. And you can see here from the early 80s, this was the creation of the the end of the gold standard, not the creation of the Federal Reserve. You can see how debt levels held by the Federal Reserve were very, very moderate, well under $400 billion. We started to get out of control with the Fed in the late 2000s. This was the housing crisis. Then we started getting into these debt buying modes where the Fed started taking on excess reserves, And you can see here through COVID, we've gone from roughly $2.5 trillion to well over $5 trillion in excess reserve the Fed's taken on. This is goes right along with that credit expansion phase, this thing here that I was telling you. So look here from 2000 to 2012. We come back over here, 2000 to 2012. You can see right over here, we've seen a fairly big expansion in credit. We've seen 120% expansion in credit and debt, Fed debt held. And now from these levels, you can see we've had from roughly 1 trillion up to 5 trillion, we've had a 400% increase in debt levels by the Fed. This creation of capital, this really, and the Fed has monetized a lot of it in debt, is what, again, will likely prompt a massive move here in gold as fear starts to unwind, pushing gold possibly up above $3,300, $3,400, possibly even well into the $2,500 or $4,500 area. And we have the real estate data. Okay, so now what we are going to do, ladies and gentlemen, is we are going to come back over here to our, one second, I need to get over here and over here. We are going to highlight our cycles, and our cycles are still suggesting that the markets are likely to bottom. We are looking for a bottom to set up. We're not taking any action yet. There are some opportunities coming. We are still going to stay 85% cash in our simplified allocation table. We're going to stay 65% cash in our more detailed allocation table. The shorter term analysis for all the S&P, NASDAQ, YM, and ES is moderately bearish. Longer term, everything is still bullish. I'll show you that in a minute. We're holding on to our allocation levels just the way they are, looking at bonds possibly to start really starting to move higher. And wrong direction. And nothing has really changed over here with regards to trending. Trending is still mixed for most of the major markets. Oil is still positive. Gold and silver are mixed, short-term bearish, long-term bullish. And I'll show you those here in a minute. Now, back over here, let's take a look at the SPY. Everything has gone into this pinkish trending, but is still bullish. Long-term, my modeling systems are still bullish. Shorter term on the daily charts here, they're bearish. Let's take a look at the ES. ES is bullish still, moderate green, bearish daily. We're looking to try to find some support, ladies and gentlemen. I think the markets are very close to trying to set up some sort of an intermediate bottom. The NASDAQ here is still green, bullish. You can see bearish on here, the daily chart. The YM, the Dow Jones, is long-term green, bullish, short-term bearish. The SPY we looked at earlier is long-term bullish, still pinkish, but still bullish, short-term bearish. The IWM, the Russell 2000, is long-term bullish, short-term bearish. IYT, the Transportation Index, long-term bullish, pinkish color, but still bullish, short-term bearish. Let's go down to bonds. Starting to form a bit of a bottom, still bearish long-term, bearish short-term. IYR, which is real estate, is still holding bullish. Look at these levels that I've drawn almost perfectly over here. Still bullish long-term, bearish short-term. I think real estate's really getting ready for a deeper contraction, and we'll see what happens when foreclosures and everything kick in. Let's go to gold. Gold is long-term bullish, short-term bearish, setting up a very solid bottom back down here near this 1800 level. And again, I think we're really looking for a nice rip-your-face-off move back at, say, 1960, 1970, possibly getting up above 2000. But I think this was a big washout in metals, and I think enough fear is is now started to move into the markets to really see gold and silver start to skyrocket. Gold, silver here is long-term bullish, short-term bearish, same thing. Look at where it was before this selling pressure started, up here near $25, $26 an ounce, a little higher. Now it's down at $21.70. I think we're going to see a good, solid 3 to 5 week rally in gold and silver, and it's going to be right back up to these highs. So this is going to be a nice, solid 25, possibly 20, 25% move. Let's take a little look here. Yeah, 20 to 25% move to the upside. Okay, crude oil, still way up in price, 110. Flagging out, you can see the lines that I've drew here. It is still bullish weekly, bullish daily. We've got this kind of a flagging formation right here, this apex with this move higher. It could run into resistance around the 115 level and really start to weaken, especially as consumers start to address these higher inflationary costs. So be aware of the fact that oil could really begin to collapse here over the next couple of weeks, and it would be more of a stair-step pattern, you know, moving down to say 90, 92, then maybe down into 70, 76, and then maybe down into 64, 65, back down into these lows right in this area. But I think we've kind of seen the peak here. Others are saying that we might see, higher oil prices. I'm thinking that consumers are really going to start to pull away here and start to really consume, moderate consumption. I have a friend that works at a grocery store, and he's telling me how consumer spending habits in the grocery store have really changed. Things have really died down. Normally Friday, Saturday, you'd see a lot of, partiers and people coming in buying steaks or what have you. He said it's completely changed. The market's changed. People are not spending like they used to spend anymore because of these unknowns and inflationary concerns. Okay, so now let's come back over here, take a look at, this is the NASDAQ daily chart. What I wanted to highlight to you on this phase here is that you can see these out of phase cycles here. There's another one here, and there's another one here. This is a market price cycle analysis. We started an out of phase cycle here. What I wanted to point out is this out of phase cycle prompted a fairly moderate recovery. This out of phase cycle prompted a moderate 3-4 week recovery before selling. This out of phase cycle prompted a sideways move before finally peaking. After all of this selling, I'm expecting this deep cycle and out of phase cycle to prompt some sort of a moderate upside recovery, which may end up looking something kind of like this, in the sense that maybe not huge, but it's not going to potentially tank like so many other people think the markets are going to do. It could still move into a broader trend, but I think we're going to see some sort of a recovery, probably 6, 8, 10, 11%, maybe back up into this area, 14,000, 13,000, say 800. But in reality, this out of phase cycle is telling us that we've just entered a very strong price cycle phase. Now we're moving into an out of phase cycle, which is almost like a recovery mode. And I believe we're going to see a bit of pause here for the next possibly 2 to 5 weeks. We'll see what happens. Let's take a look at this is the SPY. And you can see we're entering in another out of phase cycle here. So understand, out of phase cycle here prompted a recovery. Out of phase cycle here prompted a recovery. Out of phase cycle here prompted a big top. Out of phase cycle here prompted a rollover and more selling. We're starting this out of phase cycle again down here near these lows. It's tough for me to tell on this chart, but I'm going to hold to my analysis that I think we're going to see some moderate sideways activity over the next 2 to 3 weeks. I think the Fed's going to do what the Fed's going to do, but I think the markets are really looking for a bottom. I'm not telling anyone to jump into anything, get started, but we need to go ahead and wait for this to base and bottom. Now let me show you what I wanted to say was likely to be a fairly solid move. Let me move this to weekly. Okay, this is the yin, the 3X Chinese bull ETF. What I'm going to show you here is that we started to move in a broader upward cycle phase. As the Chinese market and the Asian markets have really been hammered lately, you can see we've gone from 30 at the peak over here in 2021 all the way down here to 3. And we're starting to form a base down here around 350. I'm going to tell you that money is going to start looking for opportunities. And I think money might start moving into some undervalued Chinese, Asian, and possibly other sectors. So watch how markets move. When the U.S. market, if the U.S. markets continue to consolidate, then money is going to start looking for opportunity. And that opportunity is likely going to end up being found in some undervalued, extremely depressed types of stocks, kind of like what we saw happen in 2012, 13, and 14. The emerging markets became very hot when the U.S. stock market was waning. It could be that we see emerging markets and or Asian markets start to get a little hot with money, with people piling into undervalued Asian equities, and it wouldn't surprise me to see this yin or the Asian indexes move up a good 60, 80, possibly 100% from levels where they're at right now. So pay attention that the shift of money away from risk is going to move into what appears to be really hot or potentially undervalued. In my opinion, Asian markets are undervalued, certain European markets are undervalued, and of course, gold is undervalued. This is the gold cycle. You can see we're nearing a bottom cycle here. We've got a rollover in this cycle. This is going to continue to cycle trend out, but I believe gold and silver are going to become really hot over the next 4, 5, 6 months as traders start to understand what's going on with regards to the markets and the continued unwinding that's taking place. All right, that's it for now. Pay attention to my updates. Follow me on YouTube and Twitter. Everything I'm delivering to you is to try to keep you abreast of what's going on. We've been actively protecting capital since middle of last year. Actually, about June or July of last year, we started moving to protect our capital well ahead of everybody else. And I want you to know that we're starting to look for a bottom in the market. So we're not taking any actions yet. We're looking potentially at opportunities. Metals should start to move higher. Asian markets may see a bump here in the next 4 to 6 weeks plus a bit. The money is going to start looking for opportunity here, depending on what the S&P does and the U.S. stock market does. To be honest with you, this week, I wouldn't be surprised to see the U.S. markets move a bit higher, really shock people and set up some sort of an intermediate bottom. But it's too early to tell. So we'll just leave it right there for now. Look for my updates, and thanks for following. Bye.